All right, good morning. Sorry for the tremendous delay. Let's see how many are here. See, it's a very small amount of students, so I am not sure what's happening with the class as a group, but I'm posting these videos and hoping people are watching them. I graded all your tests myself. I did not give them to the TA. I thought I'd have a look, and it's apparent that students are not following instructions. So I can only imagine that students are not listening or watching my videos. So you need to watch the videos to understand what I expect from you. I haven't heard any complaints, so it looks like students are content with the grading. But I was disappointed to see how few students followed the instructions, that you should be putting your formula out, laying out your problem with the values inside of the required or the necessary formula, and then just giving me an answer using your TVM keys on your calculator to solve. All right. I didn't see that enough, so I suspect that students are not watching the videos. They're just answering the problems, and hopefully I have to trust that you're answering them solo, although I do see very similar errors among papers. I wasn't tough with grading down papers, but I'm going to have my TA look more carefully for the next set of tests, okay? So I gave you this case. I asked you to prepare it for this week. What I'm going to do is I just left it open so that you could prepare it as you would as I solve the other problems with the 3 parts: income, investment, and present value of the tax shield. And alternately, I could ask you to answer this question, and I could prompt you with elements of the problem, and you should be able to answer that. So that's how I want to answer this question today. We're going to do this together. We're going to read through the case, and then I'm going to ask you for the pieces together and see if we got the same answer as you did. And in the process, I guess you can ask me more questions. Okay. I do want to answer it with the 3 steps as well, and we should be getting the same answer. So, any comments? Yeah, the rounding, just a comment about the rounding. Yeah, one thing for sure is to mention to you, when you make a mortgage payment, when a mortgage payment is made, it's made in dollars and cents. So that is rounded. Even though it's an intermediate step in your problem, you do round that, okay? That's how the bank will handle the problem as well. Okay, so you do have to round the mortgage payment. Some of you stored all the values and used them, and so you had slightly different answer than me, and then I took off half a point for rounding in that case. If you have other rounding problems, let me know. It looks like I'm having a feed problem. I know. Is it buffering? Oh well. Let's see. I'm turning on the Wi-Fi to see if that helps stabilize. So if you have questions about your test, you can email me. But you'll have to let me know very soon. Probably before Monday, okay? I'm not going to add any points unless you talk about, or you send me your concerns before Monday. No, Tiana, just for mortgages, okay? Just for the mortgage payment. That's the only one when you, that's the only place where you'll round intermediate calculations, not for other problems. Just the mortgage payment calculation is rounded. I did see some great results, I have to say. There were some students that did great and followed the instructions. And for people who use different methods, I was generous with the grading, but it would be easier all around for you to get the points if you just follow the instructions. Okay. So here we have James Weber Corporation, a prominent manufacturer with many production facilities across the country, has been considering opening another manufacturing plant. A recently completed feasibility study costing $2 million concluded that in order for JWC to maintain its market share, expansion should be seriously considered. So this amount is, we don't need this, right? This is the sunk cost already spent. So we don't have to consider that amount. JWC is considering Humacao as a site of the expansion project, citing the availability of industrial parks as a major reason. If the expansion project proceeds, JWC believes it can purchase land, building, and required machinery for $120,000. So what do we call this? So we're going to buy land. They're going to buy land, building, and machinery. They're going to invest in those. This is capital spending or initial outlay. This is the capital. And I break it up here. The cost of the building is expected to be $75,000, while machinery, I want to scratch that out, while the machinery will be $5 million. The building will be depreciated using the 20-year depreciation schedule, for which rates of depreciation for the first 5 years are given as found in the maker's table. The machinery will be depreciated at 7, okay? So it's the building depreciates slower. The land is not considered amortizable and as such will not be depreciated. Because changing market conditions, okay, so this will all be dealt with investment and the present value of tax shield. The price of the land you have to figure out here. You can make a calculation. So it's 120 minus 80, right? It's $40 million. All right. JWC believes that the competitive advantage associated with the expansion will last only 5 years, and after 5 years is prepared to close a new facility and pursue other opportunities. So it's a 5-year project. At the end of the 5 years, JWC intends to sell the land for an amount equal to its purchase price to the selling of the building. Sell the land for an amount equal to its purchase price. To sell the building, so that's for the land, the building for $60,000 and write off the equipment for no value. So they're going to claim a loss. incremental pre-tax revenues associated with the expansion project are estimated to be 35 million for the first year of the project and are expected to rise at 5% per year for the remainder of the project. Incremental pre-tax expenses associated with the expansion project are estimated to be 10 million for the first year, but are expected to decline at 4% per year for the remainder of the project. So what are these amounts? Incremental tax revenue, pre-tax revenue, 35 million for the first, and then rising by 5%. Incremental pre-tax expenses, 10 million for the first year, but declining. Okay, so these are, you can put these in a table of values, but I'm going to use the annuity approach. Okay? So it's fine to do it in a table, but you should still get the same answer as I do. So here we have the net working capital requirements. I've totaled them for you. And then you're told some other information. An unfortunate choice associated with Humacao is the relatively high cost of labor. JWC believes that this will result in increased labor costs, as its other manufacturing plants across the country. JWC intends to phase in these increased costs over a 2-year period and estimates that it will have to add 2 million in payroll costs in the first year. And add an additional 2 million, a total of 4 million above pre-project levels in the second year of the project. It further expects, that should be a T. It further expects that the increased payroll costs at its other plants will then continue indefinitely. Okay. And what I have here is an itemized calculation, so we can do this together. JWC's income tax rate is 40%, and it has decided that an appropriate discount rate for this type of project is 14%. Do an NPV analysis to determine if JWC should proceed with its expansion plans. Okay, so we're going to go step by step, and this is just a second way I could ask you to answer the question. The approach that I showed you, the 1, 2, and 3 parts, is also important. Okay. So, what is the impact on the NPV of the project of the $2 million feasibility study? So, in a test type situation, we know this is 0 because this is sunk cost. Maybe I should send you this document. I don't think you have this, right? I'm just sending you the document. Yeah, I just sent you the whole document, okay? You should have had all the question up to here. Okay, what is the impact on the NPV of the project of the investment in land, building, and new equipment? And I ask you just to ignore the possible tax shields and salvage. So this is just the total amount, the capital spending of $120 million. You don't have to write anything else. It's 1 point. And it would be a negative, right? It's a cash flow. So it would be a negative on the overall NPV. Okay, next problem. What is the impact on the NPV of the project of the net working capital requirements associated with the project? So from the table, let's see if I can get a copy. From the table up here, over here, well, that didn't work as well as I like. Okay, so we take the table and then we conduct a 3-step process. So we say This is the net working capital required. What is the change in net working capital required? So in the first year, or upfront, we need 4 million. By the end of the, so immediately I need 4 million. By the end of the first year, with the 4 million available, I need an additional 1 million. Then in the second year, I need an additional 1 million. And then the project is winding down. We only need 3 million by the end of the third year. So we will release 3 million. And the fourth year, it will be another 2 million. And then finally, whatever remains, the 1 million is released back to the other projects of the firm. Tiana was asking about the question above. What the impact on the NPV of the project of the investment in. So this is just the capital spending, the investment. That just goes there. So I'm doing things slightly differently, separating things. You should be able to do this as well. And then the change. So then we have to talk about net working capital investment cash flows. That's what we're going to call this. Net working capital investment cash flows. So net working capital investment cash flows up front, we need to, from the firm perspective, they need to invest. So that's a negative cash flow, 4 million. Then by the end of the first year, an additional 1 million. Then an additional 1 million. And then the 3 million will be released back to the firm. So that's a positive cash flow from the firm perspective. An additional 2 million. And then ending the project, the last 1 million. So those are the net working capital investment cash flows. Can you guys see that? Is it too small? All right, so essentially I just did this one minus this one minus this one to get this one minus this one, and so on. And then I change the sign. So now we need to see the impact on the NPV, so I make a calculation. And in the test situation, you would have to write impact on NPV or the NPV contribution would be negative 4 million. Plus negative 1 million discounted. Plus negative 1 million discounted for 2 periods. Plus 3 million. For 3 periods. 2 million, so this is pretty dry. This is easy, right? Just need to know to do this 3 steps. And then make the expression. So that's what I expect from you. Then using your CF keys in your calculator, you find that this is a negative overall investment, in other words, of 1,918,000 216.74. So $1,918,216.74 investment. So make sure you can get those numbers. Okay, so now let's look at getting the impact of the tax shields. Is that it? Okay, so I didn't leave too much space here. But I need to do this for both. I need to make a table for both the machinery and the building. Everybody's with me? You guys have done this? Hopefully you've done this and you're just checking your answers. Okay, so Tiana's asking about what I do with these numbers. Okay, so yes, so you should take this amount and store it for sure. So store, well, this is the first one I store. I didn't store the others, right? So that's store 1. Or you could have like this amount here, but you know what that is, so you don't have to, that's easy to punch in. So you could call this, well, store 1. So you don't have to retype it and risk a typing or, entry error, data entry error. Okay, so let's see. We have the machinery. Oops, sorry. Which is 7 years. Depreciation schedule. And your table will be like this, where D, the depreciation amount, the claimed amount, is D times 5 million for the machinery. So those are my columns. And I'm going to have 5 years for the project. And I'm using the values 0.143, 0.245, 0.175, 0.125, and 0.089. And then, let's go row at a time. This is 715,000. So when I take that 5 million minus 715,000, that leaves me the UCC, undepreciated cost of capital, of 4,285. So 4,285,000. So let me just focus on this first, and then I'll take care of the tax shields. So now, that's what remains. So that amount is what I multiply by this. No, sorry, no, that's not true. Sorry. This amount just stays here. What I do is continue with multiplying, because these in the maker's table are already calculated to take account of the diminishing capital amounts, okay? The diminishing or the depreciated value. So just keep going with the multiplication. So you could set this up in an Excel table, but you should check your answers against mine to make sure you're getting the right answers. Okay, so I can do this whole table first, and then, sorry, the whole column, because I just need this column times 5 million. The reason why I hesitate when I do this sometimes is because the table can be done in a different way as well. But the maker's table makes it very easy. Okay. Actually, I probably could do this in Excel for you. It's okay. So now I'm going to keep subtracting what remains to be depreciated minus the claimed amount, the depreciated amount. And so I'm going to take this minus, this undepreciated cost of capital minus this and put it here, and then take this minus this and put it here. So I just keep repeating. And again, you can make an equation in Excel that does that. And that final value is the book value. Okay? So that's all remains. In accounting terms, that's the remaining value of the asset, which we need to compare against the salvage value to determine if there are capital gains for which we have to pay taxes on, or if there's a capital loss that we can claim, also as additional loss or expense of doing business. Okay, so then finally, let's get the tax shields, which is just this column times the tax rate of 40%. So that gives you so ideally you're working this out, or you're just following along with your own answers. And the last step is to take these amounts and discount them for the net present value contribution, in other words, to the value of the project. Remember, initially, where there's zero, there's nothing in, we have to wait a year, right, to be able to depreciate. So 286. So yes, you have to write all this out for your test. So the challenge is really just to tease everything apart, to take everything apart and put them back together. Take all that information, separate it in order to answer the question. There you go. So that's for the machinery. Questions? Maybe I'll do the next one with Excel. What do you think? Yes, and the problem, I think it's 14%, right? Did I give you a different one? Do you have a different discount rate on your paper? Do you guys have these as your discount rate and your tax rate? Can someone confirm? Now, the reason why that might be different is because I had different versions of this problem. Okay, so you have the same. Okay. So that's what you use. Okay, so you want to see me do this in Excel? Give me a moment, I gotta set this up. that enough columns? Okay. Let's make this. Okay, so if I set this up in Excel, I'm going to use the equations now. So for the building, it's the 20-year depreciation schedule that I have to use. So that's going to go into the first column. So I'll write just what happened there. That's my title, year. Okay, and then the D will go here. So copying from the maker's table, that would be in the first year, and then in the second, and where did I get these numbers from now that I look at it? 5. Did I give you a reference? 713. Is that the are those the numbers you have, or did you round them? Let me make sure on my makers. Did I tell you where to get it? Let me see what I said. Yeah, okay, I gave you the numbers. Okay, good. I just pulled them off the internet, which you could do too. All right, next. I have a lot of pages open. My goodness. Okay. So next column is so for the building, it's 75 million, right? So it's going to be, that's what we're going to do. I just put a times. Okay, so I just got to multiply that column always by 75 million. And I'm going to copy it down. And I can make it dollars, so it's pretty. Get rid of the decimals. Okay. The next column will be the UCC. So you see it's much easier here with Excel. So this is the UCC. This is going to be the 75 million minus the claimed amount. And I'm just going to repeat that all the way down. Nope, that didn't work. Because why? Because I have to use that. Now I'm going to repeat. So it's this one minus, so that's the UCC minus that all the way down. So this is just the first result will be 75 million minus the claimed amount. And then after that, I always use the value above. So I make an equation where I'm always using this. I'll make it again. So you say an equal sign D2 minus C3. And then if you copy that down, it will do it for D4 minus, sorry, it'll do D3 minus C4. So, and it just knows to do that. It adjusts. This is my book value. And that's that. Finally, TC times D will give me my tax shields. So it's literally 0.4 times this amount all the way down. And that's it. Were you able to see all that? Okay, so the numbers, the values of D, I got them off the internet. You can just type IRS, and I gave you the, why is it flashing like that? Anyway, I gave you the reference. I wrote IRS publication 946, so you can find the values there. But in this class, I'll give them to you. But you should know where to get them from if I'm not around, okay? And you can even derive them for yourself. Okay, so that's it. Take a screenshot if you didn't type that or write that down. So I'm going to go back. To here. Okay, so we need to get the NPV of those amounts. Well, I can do it in Excel. Let's just do it in Excel. Let's continue in Excel. I can take it should honor order of operations. So it should be this easy. Let's see if I get the same answer. Let's see if I get the answer that I got here. 5992 643 29. Yep. Can you guys see that? Maybe you can't see it. Let's see. Yeah, you can. Okay, so I'm going to transcribe that to my to my iPad. The building depreciates slower. It's on a 20-year schedule, and we found the NPV. Now you would have to write this in a test, or you should show me the Excel spreadsheet. Because you can't just show me answers, right? Okay, so those are our amounts. Now we can store these, we can sum them. We can sum them and store them in two. So far we have that amount. What happened to my, is it down here? Okay, so we have this one stored 1 from the net working capital, and this one stored in 2, where we sum these two together. Okay. Next. So we just did D part. No. Yeah. We just did the tax shields. That was D part for 3 points. This is useful for the grader. That's why I would use this kind of method. It's easier for him to mark in parts than to mark your final answers. Okay. What is the impact on the NPV of the project of the salvage of the assets at the end of year 5? And ignore the tax shields lost. Well, yeah. Don't worry about that comment. That's just if you're using a perpetuity formula for tax shields. So the salvage, if we go back, there's 3, right? Because we didn't include land in the amortization of depreciation. Like land doesn't depreciate really. So, I mean, at least not in the 5 years of the project. So we did not include it as depreciation. So for each of these, we need to consider those book values now. Sorry, every time I try and move position, the iPad flips over. Okay, so the PV, you should have the salvage of the land, which is 40 million. So what am I doing right now? I am figuring out whether there's any capital gains that we have to pay taxes on and including that. So remember, the land will be sold for its purchase price. And if I use the formula that I shared with you for figuring this out, it would be applied like this. Oh no. And this all happens in the 5th year. And so when you work this out, you should get 20,774,746.57. So in other words, you're selling the land for the price you bought it, so there's no tax treatment. All you end up doing is discounting the salvage value. The present value of salvage for the equipment is going to be, well, we're told that the company is going to scrap it, right? They're going to claim it as a loss. So that means that there's no salvage, but there's still a tax treatment because if you remember the book value, from the table was $1 million. Minus the market value, then you discount it. Okay, so I'm using the expression in your notes for calculating this amount. Okay, so that helps you compute the present value of the salvage, impact of the salvage. Oh, you can't see that. Let me pull that down. From the problem, you're told that the tax rate, TC, is 40%. And you're told that the discount rate that we're using, the required rate of return, is 14%. Okay, and are we finished? No, we have to deal with the building, right? We have the building left. for the building, we're told we can sell it for 60 million. And the the book value was 52 million. We depreciated it very slowly for 20 years. The market value, we're told, is 60 million. I made this salvage and market value are interchangeable here. However, I wrote the formula. Okay. And then you discount that because this happens in the 5th year. Discount that 5 periods. So these are all the expressions. This one works out to be 231,638.42. This one ends up being 29,676,309.99. So I have them as decimals for you, but for each one, you can store them and then sum them at the end. So you could put, so where were we at the storage? This is store 4, store 5, and store 6. So we have store 1, store 2, store 3 from Excel, oh, I guess I used 2. Oh, well, whatever. So this would be 3, 4, 5. So you get the point. You could store them all. Okay. And then go to the next part. Okay, you could add them all together for this like you would have to get this answer for this 2 marks here. Because the question is, what is the impact on NPV of the projects of the salvage of assets? So putting them all together, what do you get? All 3 of those. Did I do that for D as well? I don't know if I did it. Sorry, because I want to get the partial answers. So D for the tax shields, let's do that too. So let's add all these together and make a single answer for this. So when you sum all of these, the answer to part E would be 50,682,000. You guys can check with me. 694.98. Let me write that a little neater. maybe I'll put it here. So 50, 682, 694, 98. That's my final answer for E. Do you guys confirm that? So that's for part E. What about part D? Did I add those? When you get to add part D, the tax shields, the total of the tax shields, I'll leave that on the screen. Well, we had these two amounts. And you sum them. I'll put it here. What you would have was 7 million. Okay, so, okay, you have the store values, good. You have a 99 on the end? Maybe I have the the equipment discounted value wrong. Did you get this value for the machinery? Or did you get like 70 cents? That would give you 99. Now, I'm gonna check. No, I get exactly that. because you put 004 and I rounded, okay. So then you put 004, because that's what I get too. And if you add that, you still get 29, but it'll be 294. I'm still learning how to use this iPad. So it's just a 4 there. Okay. So for this, you know, about getting the decimals right, for this sort of thing, I would mark so if you added these together, this would have been, you know, there would have been a decimal of 0.004 here, if you can see that. And this is 0.29. I guess I might have rounded that one too a little bit. But in the end, I get, you know, when I round for the building, let me check the building calculation. If I create one more decimal place. Yeah, it's just, this will be 492. And then this ends up being 296. So if I kept the decimal places here up to 3 and here, then I would have had 30 cents. So I guess I have to be, so keep all the intermediate calculations till the end, and then you round with the final answer here. So if you were answering this test, I'd be very liberal about the decimal places, okay? So I think that would round to 30 cents. No, yeah, this is, I went back to the tax shields just to see how I did the decimals, that's all. So in general, for answering these questions, if it's asked in portions like this, keep the decimal places until the end, and then you can round at the end, you know, for each section. So we're doing the salvage. Do you get this result if you rounded each of these portions? So let's say if I did this, yeah, rounds nicely to decimal places. So the first one's 2 decimal places. So the second one, it goes 4243. So you could store all those and then add them and round them. And the last one, it rounds to 99. So when you add all these together, it rounds to 0.98. Okay, so do your best with that. I'm not going to be so crazy picky, but you know, in the decimals, but not like I was on the first test, but I don't want you having the wrong dollar amounts. Okay, so we did that. Next, F. Incremental revenues. So I mentioned you can make this a table if you like, or it's much easier just to use the annuity expression. Now this is a growing annuity of 35, starting with 35 million. After tax, as a growing annuity with 5% growth every year. That's what you should get. And now you have to punch that in manually because there's no fancy keys for that. So simplifying this to enter it, this is 9, right? 14 and minus 5 is 9%. And I always say start here. Also, you can make this 0.6. And you can just enter 35 and remember it's in millions of dollars. So what do you get? You should have done this before, but probably used a table, right? So don't be resistant to using these formula. I'm going to expect you know how to use them, so I can ask you more complicated problems than maybe you're used to. So I get $78,665,848.23, and that's all I get for decimal places. So I'm going to store that in 6. And circle it because it's the final answer for this question. So make sure you can get that, and then try the next one, the expenses. The expenses has a declining rate of expenses, but we use the same formula. What is the impact on the NPV of the project of the incremental expenses? So it's going to be expenses. Should I wait? Did you finish that? Are you still working on that? Any questions about that? Revenues? For expenses. Expenses are also considered after taxes because they are a tax deductible amount. And these are going to be declining at 4% a year. So that is a negative G. So with these negative rates, you have to practice managing them. Again, you might have wanted to make a table, but it's so much more efficient this way. So I'm going to simplify this. This is going to be 18. This amount is 0.6. This amount in here is 0.96. Just makes it easier to enter this into my calculator. And when I put all that together, I get 78 million. Now I ignored the payroll tax effect. We'll get to that next. Okay, so let me give you some time to catch up, see if you got that value. If you're just watching, just at least try to enter it. If you're not actively trying to solve this, at least enter this. Make sure you can get the same number as me. And then I ask you, what is the impact of the NPV on the NPV? Okay, so I'm gonna check in with you. How many of you have that number or have any questions? Let's see, that 5 of you can get that value. So 78,665,000. Let me know if you got it. Let's go through. We have up to 6. All of these so far have been, well, except for the net working capital, that was a negative, right? So that's a negative impact, a decrease in the NPV of the project because that's the investment. But all the other ones were positive, right? Net impact, positive impact, incremental revenues. Now this is an expense. Okay, Ariette, I will wait for you. I'll wait for you, Ariette. Let me know when you got it. Let's see. Just be careful. Use these simplifications or you're going to mess up. Uh-oh, I get 19 million too. Now that I look at it, how can I be? Oh, that's the answer for the other one. That was for revenues. Sorry, I copied the wrong one. Good. I'm glad you checked. Yeah, I get 19 million too. So I'm going to take 0.96 divided by 0.14, 1.14, raise it to the power of 5, put a negative in front and add 1, then multiply by 0.6 and 10 million, and divide by 0.18. And I get 19 million, 217,365.70 cents. How's that? Checking if you're awake. Okay, perfect. So now this is a negative, right? Because it's expenses. So we're going to store that in 7. Good. I'm glad you guys are working on it. All right. So the people who are still working, keep punching in to get that value, and the others can move to H. Increase payroll costs at other plants. So you probably solved this. If you solved it at all, you solved it this week working with the 3 parts. Like I say, in the end, we should have the same final answer. So as we're going through this, are you identifying where you might have gone wrong or things that you might have missed? You can let me know. Let the group know. Now, I gave you so many problems. I can't give you any more problems because I need some of them for the test. So work with what you've got and let me know if you have any questions about any of the problems I've given you so far. Okay, let's look at the effect of the payroll. I'm not hearing from you. This is the last item. So you're told in the case an unfortunate choice associated with Humacao is the relatively high cost of labor. GWC believes that this will result in an increased labor cost in its other manufacturing plants across the country. GWC intends to phase in these increased costs over a 2-year period. So what's happened is they're going to have to pay the employees disproportionately more in Humacao, and as a result, they're going to have to honor that wage and pay other employees in other plants the same or more than they were making before. So I give you the worked out number here, the 2 million in the first year, and then an additional 2 million for a total of 4 million above pre-project levels in the second year. And then it further expects that the increased payroll costs in the other plants continue indefinitely. So this is a perpetuity of the 4 million. So how does that look mathematically? Tiana's asking if she should use a table or should you do it this way. I prefer the formula, but some students who are more, they've been trained in accounting, they like the tables, and that's fine. That's fine with me, okay? Whichever one you like. However, you'll notice, it's different, I think. But if you notice that you're getting the wrong answer using the tables, try this method, okay? If you're getting the right answer using the table and you can't seem to use this formula, then you can stick with the tables. But you should learn the formula approach, because this is, finance, and we did already learn these formulas. We should apply them. So you should be able to read this and punch this in. Okay, so what do we do for the labor? We have a perpetuity to deal with, and it's going to be by the end of the first year, 2 million. And again, these are expenses, so it's after tax, right? We would consider that impact because we get to save, or the firm gets to save because they claim it as an expense. So that's in the first year. And then subsequently, after that, it's going to be 4 million in perpetuity. After tax, so that's going to be the perpetuity, but that will start happening in the second year, so we need to discount that by 1 period. So let me show you the timeline if you're at all confused with what I just did. So it says it's going to be 2 million, and then it's going to go up another 2 million to 4 million, and then it's going to stay 4 million forever. So I'm going to discount this amount, and then these will be a perpetuity that I price here at PV1, right? Because the form for the perpetuity formula, remember that I get the value in my, using my formula, the value is 1 period before the first cash flow. So then I have to discount this 1 period. So that's what that's for. So both of these are discounted 1 period. And the answer that I get, remember this is a cost. The amount is 16,090,22556. But in terms of the problem, it decreases NPV by 60,090,225.56. And this you can put in store 8, and then you put it all together. Don't forget the $120 million investment. Okay, how are you doing? You guys get a final answer? And is it different from the one you had before? So what's nice about storing them in your calculator, it's easy to access and verify them. You know, you can scroll through them. I will send you the solution so you'll have it to look at. Are you summing? So let me go through I'm gonna write down the values that you should be summing. So the last question says, what is the NPV of the project? What is your recommendation? So you should have negative 120 million, which you could have stored 1. Okay, so store 0. Let's say store 0. I'm going to change my storage keys. And then this is the net working capital. And then this is the amount of the tax shields. That's a positive, right? Because that's tax savings. And then the salvage. I don't really have to put brackets here because it's positive. And this was from the salvage. And then the revenues. And then the expenses, and then the labor costs. I'm changing my storage numbers. I hope it doesn't bother you. And you could have kept all the decimal places or at some point chopped them off. In the end, what do you get? Remember this Tiana here, what we're doing for the last one is you have the 2 million here, 4 million, then 4 million forever. So the 2 million gets discounted one period, but then this we see as a perpetuity, so we can easily compute it. So that needs to be discounted as a perpetuity, but the value of the perpetuity is here at time 1, so it only gets discounted one period. Is that okay? So these cash flows become a perpetuity that gets discounted one period back. So with the numbers that I put here, I'm just going to confirm. So the investment, the initial investment, net working capital, tax shields, salvage, incremental revenues, incremental expenses, and then the labor, or payroll costs. So when you put it all together, recall 0 plus recall 1 plus recall 2, I get a final answer of 20 million. It's a positive. No, I get a negative. 20,779,997 and 50 cents. So you should reject the project because it's a negative NPV. So if I give you a test with questions laid out like this, you have to solve it like this. If I give you a question without asking question by question, you can just do it the table way, or the three-part approach, where you assemble the components together in a table. I'm not sure what you're looking at, but they're all discounting to 0. This is getting discounted to 0. This is getting discounted to 0. That's why I'm discounting both of them to 0, times 0. But if I'm going to apply the perpetuity formula, this is the perpetuity formula. It ends up here, and I have to discount it one period. So, how many of you got the final answer of 20 million negative? Over the week, you should have been working on this and come up with some answer. Anybody got close to negative 20 million? So this demonstrates that it's really good not to look at the answers, or else you have a false sense of security of understanding to work on your own and then check the answers at the end. Okay. Any comments, questions? So what will happen on your next test is you'll get some questions about the techniques for valuation, and you'll get a case. I think I scheduled it for Saturday, so as far as I'm concerned, you guys have all the materials to prepare yourselves for that test on Saturday. So I'm going to start the new materials. Yeah, that's the last case for practice, Tiana. Okay? I think you guys could be ready for tomorrow. I put it on tomorrow. I thought I put it on the 31st. Yeah, I thought. Because some people didn't want it. In my mind, I had it on the 31st. Let me see what I did with the prontuario, the syllabus. I don't think I needed to have a class last week. You guys should be able to work independently with a mountain of things that I give you. So I don't think not having a class last week is a rationale to have postponed the test, but I still preferred the 31st date. It was some students that were saying they didn't want it on Halloween, I think. Why I changed it. I don't know why I can't find it. Oh. Yeah, I have it on the 31st. So 31st is fine. Where did you see it on the 23rd? Did I change it somewhere? I can't remember, sorry. So test 2 will be on the 31st. I think I might have said I would change it. I don't remember. Okay. All right, thanks. So any comments about this? Any questions from the other cases that I gave you? Any questions from the other practice work, homework I gave you? Yeah, I think she meant 24. Yeah, 23 is today. Yes, so if you have questions, I can open up, we can arrange and I can do an office hour online. Okay, so what I'm gonna do is I'm gonna let you guys go if you don't have any questions, and I'll send you the solution, and I'll also send the solution with the 3 steps, so you can see, you can compare what you did. I'm not gonna do the table with the 3 steps. I'm just going to do, I'm gonna put everything together like I did in the other cases. But otherwise, I feel like I can let you go. You guys have to work at this. And I don't want to start a new topic, but the next topic is going to be, I have to do a statistics review with you, and then we're going to get into risk and return. How do you feel about this material? I'll probably put a connect assignment, but it won't be due till after the test, just like last time. I'm going to put a connect assignment, but it won't be due till after the test. But maybe if some students want to practice those, they can practice there as well. Okay, if you have no questions, I'll stay on for 5 more minutes, but the rest of you guys can go. No, Brian, that's it for the test. That's all. Do you want more? Do you want more material, Brian? So next week, I'm going to start the new material. So I'll send you some files, and we'll start the new material. And then Saturday, you'll have the test. No, this test is the techniques evaluation and capital budgeting. So in terms of the prontuario in the textbook, let me see the chapters to remember. The chapters are, well, it's going to be inclusive, you know, it's going to include everything you did already, because I'm still going to use information on techniques of time value of money and that. But the focus is chapters 5 and 6. And the notes I gave you on alternative techniques with IRR and that kind of problem. Yeah, chapter 5 and 6. And we'll meet on Friday. Yeah, we're going to meet for the new material on Friday. Okay, so you guys should spend this week studying, preparing, letting me know if you have any questions. And that's it. Okay, so have a good day, have a good week, and be in touch.